All right, what is good, YouTube? Welcome back to another video. If you are new, you need to absolutely abuse that subscribe button right now because we're almost at 100 subs. Big milestone, I know, but we are getting up there in the ranks. But this video is going to be extremely important because we are doing it on inverses, and if you do not know, they are an extremely trendy but also extremely useful tool that you can implement into your trading to get a higher win rate and more. So I'm going to be going over pretty much everything from the complete basics all the way to how you can put it into your model or into kind of the model that I trade in the future, which we will eventually build our way up to. Let's get right into that. All right, so first thing you're going to see here is we have inverse fair value gaps. Obviously there's two types. They work pretty much exactly the same, just one might be a little bit better than the other, and that would be this one right here. So we're going to go over this first. This is a BPR, still an inverse, but this basically means that, right, we have a fair value gap that we make right here, the 3 candle formation in between the wicks, mark that out, and then what happens on the very next candle, we reject and then instantly run through that fair value gap, completely disrespecting it. Now, what you will see is that for a BPR, I don't even have this updated on this, but for a BPR, it is technically just kind of a double fair value gap. So we'll have a fair value gap right here, still a pretty good range, and then we'll also make a fair value gap on this leg, and I'll point it out on the charts to make it more clear because there should be another candle here that'll make this a fair value gap to the downside, which basically makes this a balanced range. So we want to see price react off of this as well as right here. So again, we would have one more candle making this a fair value gap in this relative area, and this range right here would be your inverse or BPR. So now we just have a normal IFVG on the right here, pretty much the same thing, except it just doesn't create a fair value gap on the other side, right? So we have a bullish fair value gap, gets ran through, and then obviously there's a lot of wicks in this one, so you can't really see a fair value gap on this time frame. And same thing for the bearish example. We still run through it, indicating that we want to move higher, but we don't create a fair value gap right here at all. So this is just a normal inverse, and we still want to see price react off this area, but it might not be as clean or as strong as something like a BPR. So now that we have those two definitions out of the way, all right guys, so now we're on the charts, and this is our first BPR example. So as you can see, we have this bearish fair value gap that we make on the way down on this retrace, and then immediately we disrespect it, creating a BPR. Now, what do I mean by BPR? Now I can further elaborate on this because as you can see, we have a bullish fair value gap and we also have this bearish inverse fair value gap kind of stacked up on top of each other, meaning this is the range we want to see price get a reaction out of the most. And as you can see, we do end up coming down, reacting off this range and continuing higher. So that's your bullish example. Let's find a bearish BPR now. All right, bam guys. So here we go. This would be a bearish BPR. Now, as you can see, we have all of these fair value gaps right here, but we do end up inversing the biggest one right here. And what do we do after that? We end up creating a BPR because we close below this, making a balanced price range. So as you can see, we have a bullish fair value gap and a bearish fair value gap kind of aligned. And what do we notice after we retrace up to this point? We end up respecting it and then continuing lower. So that is a BPR. Now let's just go into an average inverse that you'll see. So first, let's just do a bearish one since I'm right here. Here is a bullish fair value gap that we make. Now, obviously we have this BPR above, kind of giving us a little bias on where we want to go. So what do? End up tapping that BPR, and then we immediately disrespect this bullish gap. Now, as you can see, there is no bearish gap to make that BPR, but we still have the IFVG. And as you can see, we react off that point and continue lower. So let's find a normal bullish IFVG now. All right, guys, I'm going to pick this example because it is not as clean, but you still need to understand that something like this is still technically an inverse gap. So right here, we have this really, really big bullish candle. Now, what do? End up chopping it, respecting it for a while, but right here, we do end up closing above it. Now, what can you see? We end up respecting this as an inverse now. So we end up retracing in it, still staying within this range, and then holding it all the way until we move higher, as you can see. But you do not want to rely on it as much as something like a BPR, in my opinion. There you go. Those are the two examples. So now I'm going to show you what fair value gaps you should expect to get inversed and which ones you should expect to hold. Now, this is very important because a lot of people right now like to take kind of pattern traded inverses. They'll see an inverse on the 1 minute and take it in whatever direction and end up getting stopped out because it instantly reverses. Now, obviously, that is not how you want to use an inverse. It is sort of just a confirmation of where we want to go. And that is the only way you want to use it. So I'm going to kind of show you how to use that to understand which are going to get inverse or not. start on the 5-minute. All right, guys. So first of all, here we have a bullish inverse. So now you can see we have this nice bearish gap on the 5-minute that we end up inversing right here. Now, let me just hop in a replay to show you kind of what you would be seeing, because obviously in hindsight, it is going to look very bullish, right? So you're looking at this, you see, okay, we inverse this gap. We don't really have any gaps above, and this seems like a good mark of liquidity to be our next draw. Now, not a bad idea, but what you need to understand is the higher time frame here. It is the most important thing when you're trading inverses, because you need to understand what type of bias you should have, right? If we are inversing to the upside on a very bearish trend, you can not expect that to hold, right? So we make this nice inverse kind of BPR thing right here, right? But let's look at the higher time frame. What are we doing? We're dumping to these lows. We're dumping past all of these. We've just taken liquidity. It would not make sense for you to expect an entire reversal off of that 5-minute confluence, right? Would not make any sense, especially because we have all of these lows right here. So what you want to be doing instead is find the retrace and then get the inverse in the direction of the trend. So this is a bad example of how to use an inverse, because as you can see, we play this out a little more. We don't even reach your draw of liquidity before getting inversed on again, right? We can use this exact same example to show what type of inverse would be good. Now, let's say you're going into this day with a very, very bearish bias, right? Which you should be, because we're in a bearish trend and we make this big gap right here. So you want to see some lows down here get hit, even though we already took liquidity. You want to see us go lower because we're not confirmed to move back up. So you're on the 1-minute, and what do you see? We have this big gap here. Now you are aligned with the trend. You have targets below on the higher time frame that should get hit, and you have, an inverse to enter off of. This is an inverse that's good because it is aligning with the trend. It is on a retrace. This is a retrace, right? That is what you have to understand. On the hourly, on the 5-minute, on the 15-minute, this is also going to be a retrace on the bigger time frame. This is not going to be a reversal, and that would be a good inverse to take. So something like this, you're playing it. I think I've literally took this trade before, but we have this very clean inverse of the BPR. We have all this low resistance liquidity. It would make sense for us to go and take, probably all of this liquidity and move lower. So again, that is what you have to understand with inverses. You want to be taking the inverse on a so-called retrace, in my opinion. So that is how I use them. Let's go on a bullish example of how you'd use that. All right, guys. So now I'm on the 1-minute. This is a bullish example of an inverse you want to be looking for and expect, right? So as you can see on the 1-minute, we do look kind of bearish, right? We have this very big gap. Let me just hop in replay again to kind of give you the thought process here, right? We have this very big gap and we retrace up into it. But on the higher time frame, what are we doing? We are retracing. So this would not make sense for you to take because we are in a very, very clear uptrend, right? Why would you want to be shorting into this gap? So this is a retrace that I would expect to not hold, right? This is not something I would expect to go lower on, especially because it's only on the 1-minute and we already took all this liquidity. There's not really any clear targets here except this low. So that would not be something you want to take, right? So let's just play it out. Bang, we get that super, super nice inverse. You take that, say you take this, you're trying to get these lows, but what happens here? You get stopped out. Now, why are you getting stopped out? Well, that's because on the higher time frame, we have already taken liquidity and we are in a very, very bullish retrace. So this is an inverse I would expect to hold right here. Boom, because we are in line with the trend now. We are on that bullish retrace now, lining up with the higher time frame, and we want to see something like these equal highs appear. This would be something you could take an entry off of. This would make a lot more sense in terms with the higher time frame. I don't even remember if we get stopped out here. We'd get break even, but you get the point. It does play out, but this would be something I'd expect to hold. And again, let's say you do expect that retrace again out of this gap. Now we swept liquidity here and we make a very, very nice inverse here. Even though it's just a little gap, we still do inverse it and sweep liquidity. This would be a pretty good entry model right here. And again, it's aligned with the higher time frame trend. So the last thing you want to be doing is taking every single inverse because we will get a lot of inverses. They're always going to be happening and you can't expect them to hold, Last thing I want to talk about with inverses is what exactly makes an A+ inverse. So there's pretty much 3 things. What I'm looking for is where is the inverse located? So what do I mean by that? I would mean if you're looking on the higher time frame, are we getting this inverse to the upside right here when we're retracing into some sort of gap? Or are we getting it, let's say we're retracing into a bullish gap, and let's say we get a leg up, and then an inverse right here. Would it make sense for you to take this inverse to go back into this gap? No, it wouldn't at all. This is exactly what I just showed you right here. That last example, that's exactly what I just showed you, because we've already tapped our interest level and we're not looking to be bearish anymore. So why would you be taking the inverse? I don't know. You'd be an idiot. So that's what you have to understand. Where are we located? Another thing we have to understand, what time frame are we getting inverse? All right, I don't think I have to explain this too much here because, as you know, higher time frames do hold higher power. I'm pretty sure we all kind of know that. So if you see a 1 minute inverse into a 4-hour fair value gap, don't expect that to hold because we want a 4-hour inverse to validate that gap. Now, this is something I used to have some troubles with, particular because I would be taking kind of 4-hour gap, 1-hour gap reversals and enter off an inverse, and I get instantly stopped out because we are not looking to be moving in the direction on the higher time frame yet. So align your time frames, make sure we look bullish on the fair value gap or liquidity that we are using. Do not try and snipe the bottom. In my opinion, you are going to get a low win rate using that, and it's just not going to be worth it. Now, third thing that you want to look for is what time of day is the inverse happening. Now, for me, this is kind of important because I've noticed when it is an hourly candle close, a 15-minute candle close, and 5-minute candle closes, that really matters. So, for example, you want to see sort of an inverse when we have like a hourly change. So, right here, for example, we move up into this gap and then it turns 1 o'clock, literally at the very top. Now, when we have an hourly candle close, we usually do see some sort of reaction at that point. And I'm sure a lot of you use macros. That is pretty much kind of how it works, is the macros in between that time, we want to see some sort of manipulation. So let's say this would be your manipulation. That is why you are seeing an inverse right here. Obviously, this one didn't play out. This is my bad example because you have to align the situation here, right? We do end up moving off that 10 a.m. candle, but what do? We do end up rejecting because the higher time frame, right? I already mentioned that, but the time of day kind of does matter. Obviously, if you're trading something like Asia session and it's very low volume and you get a 1 minute inverse, are you going to expect that to hold? Probably not. Probably not. It's not going to really work out for you too well. And yeah, that is pretty much the entire video. I will be showing you more how to implement that in the future, but for now, this is pretty good. So just make sure you have these things lined up for your inverse. When is it happening? What are we looking to do? What is the higher time frame showing us? Are you using the right time frame to get that inverse? And what time of day is it? Is it about to be a new hour? Did we wait for the 15-minute candle close? Are we respecting a gap or rejecting on another time frame? You have to have that sort of thing because you will get faked out by inverses. We all have, and some of them won't work the way you want them to. So don't pattern trade. That is pretty much the main thing of this video. Do not pattern trade them because they are super easy to understand. One more thing I want to add is a good inverse is going to be very V-shaped. So something like this, a V-shaped inverse like this, after sweeping some liquidity or rejecting out of a gap, is going to be your best inverse. Now, if you have this aligned with your time frame at a good time of the day that you expect to get some sort of reversal or some sort of move, and we are located in a good spot on the chart, let's sweeping liquidity, tapping a good gap right here, and we're rejecting with speed, that is literally an entry model right there. So there you go. That's inverses. Hopefully you guys enjoyed the video, and I will be showing you how I implement the inverses in my own strategy soon. So don't worry about it if you are trying to make this an entire entry model yet. We will get to that point, and hopefully you guys enjoyed it. If you have not joined the Discord, join up down below. We are actually growing that shit hella fast, and it is pretty nice. We're taking live trades. We're doing back testing sessions. We probably will do more soon in the future, but yeah, super hyped on that growing. And if you have not subscribed, again, absolutely abuse that subscribe button right now because we got to grow this together. So hopefully you guys enjoyed. See you next time.